These are younger versions of ourselves.
Speak for yourself, Shawn.
Hi, everyone. If you're joining us, we're just going to give people a minute or two to join, and then we'll get started. Okay, hello everyone. Thank you so much for joining us. We're just thrilled to have you here. I have joined with me today Professor Shawn, Cole, and Vikram Gandhi to discuss sustainable investing. And before we dive in, I'm just going to briefly introduce these two, and then I have a few questions for them that I prepared, and then we'll open up the floor to questions from all of you. So as we're talking, feel free to submit any questions you have in the Q&A box, and we will get to as many as we can. So a couple quick intros to start. Shawn Cole is the John G. McLean Professor of Business Administration at Harvard Business School. He's an affiliate of the National Bureau of Economic Research and the Bureau for Research and Economic Analysis of Development. He is also a co-founder and board chair of the global nonprofit Precision Development, which provides customized digital information and services to smallholder farmers in developing countries. Vikram Gandhi is a senior lecturer of business administration at Harvard Business School. He's the founder of the impact investing platform Asha Impact, and a senior advisor to the Canada Pension Plan Investment Board. He is also a chairperson on the board of Growth for Good Acquisition Corporation, a special purpose acquisition company which seeks organizations with innovative solutions critical to creating a more inclusive, sustainable world. And most importantly for this particular audience, they're the co-faculty for our HBS online course, Sustainable Investing. So let's dive right in. And I think maybe to start, it would be helpful if you could just, each of you talk just a little bit about your background, such as your research and interest in teaching, and how you became involved in the sustainable investing space.
Great. Well, I'll start. I'm an academic by training. I did a PhD at MIT in economics and then joined Harvard Business School, where I've been teaching finance since about 2005. I got into impact investing because I was very interested in poverty alleviation and financial services for the poor. I was teaching a class called Business at the Base of the Pyramid for MBA students, which focused on the, more than 1 billion people earning less than $10 a day. How can you build profitable businesses that improve the welfare of this population segment? And the students started asking me about impact investing. So I started writing some case studies on it. I got very intrigued. And then I actually had a conversation with Vikram. I had been thinking about launching a course on impact and sustainable investing. And he was an alum of the school and said he was thinking about returning to HBS to do the same. So we decided to join forces, but I'll hand it over to Vikram.
That's great. Thank you, Shawn, and delighted to meet all of you. Very glad that you joined. As Natalie said in the introduction, I'm a senior lecturer here at the business school. And we, for those who may not be familiar, at HBS, about 25% of the faculty are people like me, who I would say, compared to Shawn, who are PhDs and illustrious academics, we tend to bring the IQ of the average faculty down a bit by working in the real world, et cetera, as opposed to pursuing kind of a purist approach to life. But so 25% of us are like practitioners. I've spent my career in financial services at Morgan Stanley and Credit Suisse. in different locations, including New York, London, Hong Kong, and Mumbai. And joined the faculty at HBS about 6 years ago after spending my career in financial services. The whole thought process for me was, how do I take the skills that I've learned on the banking side, investing side, and bring it to earn returns for for investors, for myself, and for others, but also be doing good at the same time. And this is about 10 years ago, this whole concept of impact investing and ESG was just, people were wondering what it is, scratching their heads. And as Shawn said, I was thinking of coming back to the business school and trying to figure out whether there was a way to build a new course on the topic. And I was delighted that Shawn wanted to partner up with me, and we felt that we had some excellent complementary skills to develop a new course, which is what we did. We spent nearly 2 years writing a lot of cases, which are in the online version as well, and then have been now teaching it for 5 years in the MBA class. And lastly, in terms of the genesis of the online course, we felt we had developed some really good material for the MBA class, and a lot of cases, a lot of research, and figured that, why not take that and build it out into an online course, which is how we spent, the last year developing this course, and I guess we're in the third cohort now.
And I wouldn't want Vikram to sell himself or his colleagues short. I think that practitioners have all had spectacularly successful careers in the private sector and come back to share their knowledge and help inspire students. And so, I think it's actually a perfect wedding for this topic, because we need a lot of practical experience. I was writing a case on SKS, a microfinance company in India, and Vikram was like, oh, I led their IPO, and they had $1 billion IPO and were one of the first very successful impact companies to go public. So he brings a lot of deep institutional knowledge and real world practical experience, and I can help develop and apply analytic frameworks that can help us try to separate the overselling from the true claims in the space, and really start to understand what's going on in these sectors.
Yeah, and I think that's one of the really lovely things about your course, is the conversation between the two of you in it. So I think that's a really big bright spot in your particular course. And one thing that I think can be confusing, particularly if it's for people who are newer to the field, is there's just a lot of terminology that people might not be completely familiar with, or just might use differently. So I think for the purposes of our discussion today, would you mind just defining how you would define sustainable investing and impact investing?
Okay, maybe I'll take a stab at that first, and then Shawn can add. So the way when we are developing this course, and again, like I said, when we started doing this 6-7 years ago, this topic, when you talked about ESG and impact investing and broadly sustainable investing, people would roll their eyes and what is this, et cetera, et cetera. And now, because it seems to be a lot more mainstream, has its own issues, which we'll talk about going forward. But the idea really was, as we were looking at it, is let's build something and material, which is what this course is also about, from an investor lens. And so if you think about the basics of investing over the last 50 to 100 years, it started off with investors just thinking about returns and saying, okay, well, this is a return, and if X investment has a better return than Y investment, then X is better than Y. Then there was a whole body of knowledge developed academically and in practice that, two investments may have different risk profiles, and therefore a high risk investment should generate a higher return to compensate for that risk. And so there was a whole body of knowledge developed in terms of investing being a combination of risk and return. We are targeting risk-adjusted rates of return. So yeah, there's a return, but it's adjusted for risk. And I think over the last 10 years, and I think it'll go on going forward, is that there's a third dimension here, which complements both the risk and the return piece, which is the whole area of impact and ESG. What we try to do is, our course was initially called Investing, Risk, Return, and Impact. And we felt that maybe that was too narrow a focus. And so we expanded to include sustainability, which includes a lot of the ESG things, which we will talk about. So it's really bringing a third dimension into the investment process, which is thinking about sustainability. And if I use the ESG framework, the environmental issues, societal issues, good governance, in terms of both helping to enhance returns and, equally importantly, helping to reduce risk. And so it's a third leg. And so as we think about sustainable investing, think about it as investing, where in addition to the traditional risk and return metrics, you're adding a third leg, of sustainability, which builds into those two fundamental tenets of investing. Shawn?
Yeah, I think that's exactly right. And I think one reason, and so this very simple definition I often give is, making investment decisions which include non-traditional considerations. So traditionally we care just about risk and return. Now we might care about worker welfare or carbon emissions or other topics. I think one reason, though, that there's a lot of confusion is that it's such a very nuanced topic. And when you even think about ESG investing, there are actually two quite different views about what ESG investing means. I think there's one view that says these ESG topics can affect cash flows, right? So if Exxon doesn't correctly predict demand for oil and demand for oil drops, then Exxon's investments will not pay off and Exxon shareholders will be worse off. And so it's very hard to find people who even argue or disagree with that, right? We need to know what factors are going to affect firms. You might have different beliefs about the probability that climate change events are going to come to happen. But I think the investing world has largely gotten around the idea that we need to understand what these environmental and social and governance risks are and how they might affect firm performance and cash flows. But this discussion of ESG is, I think, often conflated with a second view of ESG, which is more the view that by getting firms to change their practices, maybe there can be a positive impact on the world. And so I think the Harvard students who are marching in the college, yelling, what is Harvard doing with its investment? They're much more focused on what is the impact of firm behavior on the world, and maybe not necessarily as focused on cash flows or profitability. So when you engage in conversations with colleagues or investors or managers, it's really important to understand what perspective they mean when they say ESG, right? So you might think, a simple example is if your corporate headquarters are in Miami, you're exposed to climate change risk. And maybe by some metrics, then moving your corporate headquarters farther inland or to Ohio could improve the ESG risk score for that company, but it wouldn't do anything to affect carbon emissions. On the other hand, a second lens is to say, well, how much CO2 is this firm producing? And maybe by changing production processes, such as not flaring methane, I can reduce my greenhouse gas emissions tremendously at little or maybe even no cost to shareholders. And that would be the ESG lens that focuses on how what is the impact of the firm on the global economy? And so I think people often show up and look at ESG data expecting one thing and see a different thing, and then they throw up their hands and say, oh, this is all gibberish or this is all garbage. What can I learn from it? And I think what you really need to do is say, yes, it is. The world is an incredibly complicated place. And so let's be very systematic and thoughtful in how we approach things like ESG metrics or impact investing.
Yeah, that's super helpful. I mean, I think things like this can just be very overwhelming when you see all these terms. So it's really helpful to hear you.
It's called the alphabet soup.
Yes.
Of sustainability.
Yes. As you mentioned, we're having just many more conversations about these types of topics than we were 5 years ago, 10 years ago, 20 years ago. What trends or emerging trends are you noticing that you're keeping an eye on in the field?
I mean, I think there are a lot of trends. Obviously, I'll talk about a couple. One is just, I think, a much greater sophistication and awareness of these topics, and maybe especially in Europe, where the regulation is really starting to dictate what firms can and cannot do to call themselves, focused on impact or sustainability, and laying out pretty high standards for disclosure and for behavior. And we see this in our MBA classrooms, where 5 or 7 years ago, we might have had a very introductory conversation on a case study. Right now, when we cold call the first participant, there's already a very deep and nuanced comment that's coming out, and the students' level of understanding of these topics is much greater. So I'm seeing much greater awareness and interest pretty much across the spectrum. And maybe that's the most important trend, that this is moving from something that was really a niche topic to something that's core to investing.
I think just to add to that, is that if I break that same analysis or comment that Shawn had into a little more micro, so if you look at the actors in the world today, broadly speaking, there's government, there's regulation, there's corporate, and there's individual. And then obviously corporate, I'd say corporate is organization, could be nonprofits, et cetera, so organization. And I would say that the big trend in all three is a real big push of of incorporating sustainability, not just in the investment process, but in the operating process, in the way that people live, et cetera. So on the regulation part, what we've seen is that, as Shawn said, Europe has been ahead of the curve, but we're starting to see big shifts in the US as well. Where, for example, recently the SEC has announced requirements, or at least got a paper out there for comment on requirements of including ESG metrics in financial disclosure as a requirement, as opposed to kind of a qualitative assessment. We're starting to see those kind of trends emerge in Asia as well. So you're starting to see regulation kind of saying, and why? Why is this? So the reason is that, if I look at the SEC piece, is that their job there is to protect the investors. And the reason why they're pushing this is, partly maybe we need to do good for the world, but I think the fundamental is that's not what SEC's job is. What their job is to protect investors. And what they're saying is that to not have proper sustainability data in your financial reporting, you are actually not providing the right information for investors to make informed decisions. And that's a big, big shift compared to, say, even 5 years ago. So that's one. I would say on the corporate side, there's, as you've probably seen, that of the 22,000 largest corporations in the world, over 700 have announced net zero targets. And that net zero is increasing by the day. Of about 195 countries that exist in the world, about 140 have announced net zero targets for the country as a whole. And people in their own daily lives, I mean, at least I know I am, I know Shawn is, my kids for sure are really thinking about, like, what is their carbon footprint? Is this right or is this wrong? A lot more awareness. So if you break it down into all three segments, both from the point of view of value, which is the two distinctions that Shawn made when he was talking about the complexity of this whole issue of sustainability and which lens are you looking at from. So there's the value piece, that for preserving value and creating a lot of enormous value going forward, if you do it right, you need this data, and there's a big trend towards that, and you need good regulation. And the other is the values, which is, I want to live in a world, I want to leave, my kids and grandkids in a world that actually exists. And so therefore I have, regardless of what the near-term implications of financials may be, I have a duty to actually push this. So an enormous amount of awareness across all elements of society is what we see. And I think, partly, as you've seen this, we talk a little bit about the ESG backlash, which I'm sure, Natalie, you're going to have some questions on over the last 6 months, is largely because there's so much noise around this. It's like the Wild West. I mean, just think about it, 100 years ago, getting to the industrialization phase of this world. That's where we are. And the Wild West creates enormous amounts of risk, enormous amounts of uncertainty, but more importantly, in our mind, enormous amounts of opportunity. And so therefore, kind of making sure that you kind of get through the noise to figure out where the opportunities are and do it in a sensible and smart way is, to an extent, what our course kind of tries to get to.
Yeah, you mentioned something that segues nicely into another question I had, which was just the metrics around sustainable investing. So you mentioned there's just been this proliferation of data. Can you talk about maybe what are some that are most commonly used? What do they mean? What are some shortcomings of metrics? We do have some free content on our website about impact-weighted accounts, that type of thing.
Sure. So maybe I'll start with a slightly bigger picture, and I did my PhD at MIT when the Poverty Action Lab was being created, and that research movement got the Nobel Prize in economics a couple of years ago. So I've had sort of a very close lens on what it means to define and measure impact. And I think people often have some objections to the idea that we should care about impact and that we should measure it. And they say, what are some problems? One is that impact may mean different things to different people, right? So Natalie might have one view on abortion and somebody else might have a different view on abortion. And so how can we even talk about impact if we don't even agree on our basic values? So that's one criticism. A second is, even if we did agree on our values, how could we really quantify stuff, right? So how could we say, what's the value of saving a life versus reducing a ton of emissions versus promoting democracy, right? How can you possibly assign a number to that? So what's the point? It's just too hard. And then a third criticism is, even if we could do all that and assign numbers, how could we say that our investment is actually making a difference, right? So if I'm a sustainable investor and I want to reduce carbon emissions and I invest in Tesla, if I'm just an early stage investor and somebody else would have made that investment anyway, and Tesla would have succeeded anyway, then maybe I can't really say that my impact has any value. So this is one area I think where both academics and practitioners have made a ton of progress. And so I think just to answer those three critiques briefly, the one is, how do we align on values? I think the industry is aligning around the Sustainable Development Goals, which are a set of goals articulated by the United Nations. And it's not really pie in the sky, because if you look back to the Millennium Development Goals, which were their predecessors, those were actually achieved ahead of schedule. So the SDG is an ambitious set of goals, but it's quite nicely categorized and allows us to sort of say a somewhat democratic consultative process that went through the United Nations came up with this set of beliefs. And if you look at any one of them, it's just hard to be against that, right? Do you really want to promote hunger in countries? No, one of the goals is zero hunger. So that's helping to align values. I think there's been a ton of work on impact quantification and impact measurements. As Natalie mentioned, the impact weighted accounting initiative is trying to come up with a first pass or a best guess of the impact, both positive and negative, that is created by firms. But academics also, for example, at the Poverty Action Lab, have been doing thousands of studies trying to study different sectors and quantify and define impact. And I should have we should be disclosed, I have some advisory roles to Y Analytics, which is part of TPG Rise and BlackRock. But if you look at TPG Rise, they have done a very thoughtful approach to look at academic literature and try to quantify that and then convert it into a comparable metric, a financial term, so you can start to do cost benefit analyses and start to make these trade-off decisions. And then finally, on the attribution question, my friends at the Poverty Action Lab are doing lots of randomized controlled trials that, for example, there's a private school in Kenya, they'll pick 10,000 children and 5,000 of them will get a free admission to that private school. And they'll track those 5,000 students over 2 years and compare them to the 5,000 students who continue to attend public schools and show that they actually have substantial learning gains if they move into the private school. So there's been a ton of effort around the world to try to answer these questions. And while they're not yet fully solved, I think it's really impressive how much progress we've made in the past 10 years and how much progress I think we're going to make in the next 5 or 10 years.
Yeah. As Shawn and I talk about in our class, you talk about accounting standards and FASB and IFRS, FASB in the US, IFRS elsewhere. It took over 100 years to actually develop accounting standards that everyone kind of adhered to. And even today, even though you have it, there's a lot of debate and discussion about reserves and how do you treat this and how do you treat that. And so even though there's a kind of an agreed upon standard, there's still a lot of judgment even within that. And so when you guys were referring to the alphabet soup before, well, in terms of impact metrics, that is like the big person of alphabet soup. I mean, it's like, but I see what's been happening here between a lot of the initiatives that Shawn just mentioned, that we're kind of converging. There's from a climate standpoint, there's the TCFD, the Task Force on Climate Disclosure, which has really identified quite systematically both technology risk as well as operational risk, and thinking about how to incorporate that into financial disclosure. A lot of companies and countries are trying to do that. And then SASB, along with the Value Foundation, kept coming together, and IFRS, the foundation, really trying to kind of come up with global standards. So as Shawn said, the hope is that we will be able to come up with global standards. You'll always have this issue of how do you, there is always be this apples and oranges issue. But to try and convert everything to a number or numbers with some qualitative background, at least is a first good step in helping both companies, policymakers, individuals make sensible decisions. I mean, just like with financial accounting, you can look at the P&L, you can look at the balance sheet. It's been done according to principles and standards, but ultimately, personal, judgment as to how to interpret that data and what does that mean in terms of interpreting that data and taking action as a result of that data is not something which is just, mechanical. And so I think you'll always have that issue across all metrics, both financial and impact oriented.
Mm-hmm. Yeah, that makes a lot of sense. I have one more question, and then we're having some questions come through in the Q&A box. So then I'll switch it over to the audience questions. But the last one for me is, and I've noticed this in some of the feedback we've gotten from your course, people really enjoy learning about the role of sustainable investing in public markets. So could you talk a little bit about divestment versus engagement strategies, pros and cons, how you think about those types of topics.
Maybe I'll start with that one. The public markets, by definition, even some of the largest shareholders will have dispersed ownership. You don't have a concentrated ownership, and so therefore, while if you look at just typical corporate governance structures anywhere in the world, the shareholders elect the board, and then it's the board's jobs as a representative of the shareholders to implement whatever strategy that makes sense and operational, et cetera. So that's the kind of broad structure. It's got nuances in different parts of the world, but broadly that's where it is. And to the extent that it's a private company and the shareholders and the board are one and the same thing, it's much more easier to actually influence and influence outcomes. In a public construct, even the biggest ones like BlackRock and Vanguard and State Street, while when you combine the three, they probably own 20% of all companies or 20% of most companies in the world. They still, on an individual basis, while big, are not big enough to actually make things happen overnight. And so the question then is, what role should shareholders in a dispersed ownership like public markets play in influencing outcomes? Again, for two reasons. One is to influence outcomes because as shareholders, they want to preserve long-term wealth and create long-term alpha and value. And so therefore, incorporating ESG, if they believe is important to make that happen. So pushing managements and boards to do that. And the other just maybe, as a shareholder, I have a certain set of values and I'm not going to invest in X, Y, and Z. And so therefore you express it that way. And so there are various mechanisms of going about this, but the two broad ones, like you said, Natalie, are divestiture and engagement. And what's the difference there? So divestiture is like what Shawn was saying, I think now Harvard Endowment's got a policy around investing in natural resource-driven companies, et cetera, fossil fuel-driven companies and industries. But I remember just till a year or two ago, during commencement, et cetera, you'd have massive marches and students saying, divest, get out of everything that's fossil fuel. And the Howard Endowment would say, well, our job here is to generate a return and protect the investment over time. We want the flexibility. At some point, sometimes it may make sense to actually buy something in fossil fuels. For example, not that Howard Endowment said this, but if I bought an oil and gas company a year and a half ago, it was a fabulous investment from a financial perspective, because given where oil prices are, the demand-supply imbalance. And so the flexibility to do that would be one. And the other objection to divesting is that by divesting, you're actually moving away from making a change because you don't have a seat at the table. You're not having the ability to influence. The engagement strategy is a much more kind of nuanced strategy, saying that as a shareholder, if I believe in the long-term value of a company, then I will engage with that company as the owner or as one of the owners in influencing outcomes. And we have a great case that Shawn and I wrote along with a few other professors on the engine number one Exxon situation, which was very similar like that. A lot of companies just got out of Exxon because they don't want to invest in fossil fuel companies and oil and gas companies, while others felt that Exxon actually has an enormous upside potential as a company. It was undervalued. It can be a leader in the carbon transition plan in terms of generating great technologies on carbon sequestering and hydrogen, et cetera, that engaging with the management and changing the board may be the better way to go, which is how, there's more details on the course, but how they managed to kind of bring about change. So this debate is ongoing. I find that in the practitioner perspective, that when I talk to investors, there is the philosophy of divesting. Like, if I'm a religious organization, big pools of capital, or if I'm a family office, and I do not believe in certain things, I will just divest of them. And so that's, understandable. But in terms of most institutional investors, you would find that they mainly gravitate towards the engagement strategy. They may divest because it's a bad investment or long-term risk or et cetera, like a lot of the California pension plans divesting out of tobacco and even out of natural resources. But I think the part is that, hey, look, as big shareholders, we want to preserve value over time, and therefore engagement is the right way to go.
Yeah, and I'll just very briefly mention, right? So the people talk about universal ownership. So State Street, BlackRock, and Vanguard are committed to own these funds because they're indexing. And so then they start to think, well, how can we maximize the value of these companies? And so engine number one is a super example of a fund that just bought, I think, $40 million of of shares in Exxon and managed to, in a very contested election, put 3 board members on the Exxon board who recognized the importance of the coming energy transition and would help guide Exxon to reduce its emissions and start to make more strategic investments.
Yeah, I think those strategies are just so interesting, the ins and outs of them, and where you might be able to leverage your influence. We did have one question come through on Zoom, and we've had multiple come through that were similar in terms of people who had registered and submitted a question. So this question is from Turi on Zoom, and they're asking, how does the economic state of a country affect sustainable investment there? So, for example, during a recession, or a country that's a developing country, how does that affect the sustainable investment field there?
Well, I could take a first stab at it. I mean, just spending a lot of time in India, and let's use that as an example. I would say that basically 2 things. One is that compared to, say, Europe for sure, and even the US, the whole focus on ESG and sustainability is just starting to get a lot of traction. So it's really behind the other 2 kind of areas. But now that it has got traction, I mean, the countries announced net zero 2070. They're trying to put a plan in place to make that happen. A lot of the shareholders of companies are very clear that, I mean, India has a huge coastline. It's just like Florida and other places that Shawn mentioned before. It's susceptible to climate change big time. And you've seen, like in Pakistan, the droughts recently. So there is a major realization here in the last year or 2 that this is not something which can just be kind of pushed at the classic kind of politician thing, just kick the can down the road and hopefully things get sorted out. I think people are in a lot of developing countries focused on this in a big way. The big difference obviously is that you have to balance that with economic growth and the requirement of energy, and how should one think about energy sources between traditional fossil fuel sources and renewable sources. And that's going to be not a tougher, but it's going to be a longer kind of transition. But it's got to be a thoughtful one. For anyone saying, oh, the emerging markets should just shut down fossil fuel and go to renewable, it's kind of interesting to say, but it's impractical and it's not going to happen. But a thoughtful transition, just like any company, the same for a country, a thoughtful transition over time that balances development needs, the demand of energy for the growing population and the growing income levels of the population, coupled with the fact that ultimately that will be interesting if we grow and develop, but we don't have a country to actually live in. So balancing those 2 it's a tougher call, I think, in emerging markets. And second is, who's going to finance this? There are a lot of emerging markets and developing countries will talk about the fact that, look, this climate problem, let's just take that for a second, has been caused by the West. That's where all the carbon emissions have happened, or predominantly happened in the last 100 years. And so shouldn't they foot the bill? It gets back to like a company. If they've been emitting all this time, should there be a carbon tax? Should they be responsible for increasing healthcare bills that occur because of climate? So there's this other big debate as to who actually pays for this, because a lot of times these countries do not have the ability to pay. So I think there's going to be this major movement of north-south capital flows too at some point. But that's something which is going to take time to resolve itself.
I'd love to take an opportunity to address a couple of questions that have come in on a really important topic, which is impact washing or greenwashing, right? So I won't comment on the specific cases of any particular company, but there's been much greater scrutiny over the claims around ESG investing in the past years, and I think genuine concern from investors about whether their investments are really having impact. And I think at some level this isn't a surprise. Whenever there's a new opportunity, folks are going to rush into it, and they may do that with more or less levels of sophistication and cynicism. But I think it certainly does speak to the importance of professionals developing deep competence around these topics and being sure that they can design and execute strategies that deliver on their promises. So there's a specific question about impact measurement in private equity. And we talk in the course about the operating principles on impact management, which are a set of 9 principles proposed by the IFC, which aim to head off impact washing. And so I won't go through those in great detail, but they require firms that sign them to define their strategic objectives, manage the portfolio on a strategic impact basis, measure and report on the impact, including successes and failure, and to have that measurement audited or at least verified by third parties. So there's an increasing set of efforts to bring the tools of accounting, which we have learned are not perfect, but are often quite helpful in producing transparency over to the impact side.
Yeah, I just want to add to that. So I see there's a couple of specific names, et cetera, in the Q&A. So I just, one thing to distinguish is an asset owner who owns the money, which is like a pension plan, insurance, endowment, family office. It's their money and then they invest. And sometimes they invest directly into companies and private funds, et cetera. But that's also funds, or they invest through asset managers like mutual funds, PE firms, venture capital firms, et cetera. Intermediaries like some of the firms mentioned in the chat, the Q&A. And if you think about what the goal of the asset manager is, their goal is obviously to service their clients, meet a demand, and to build their assets under management, which then results in higher profitability over time. And so what's happened, I think, in the last year or two is that given the increasing demand on the part of asset owners to have more exposure to investments that have a sustainability orientation to them, there's been this plethora of products that have been created in response to that demand by asset managers. And I think just like has happened over every cycle or hundreds of years that I've seen or read about, that, things go in excess. And I think there was clearly, it seems to be, in the last couple of years, an excess in terms of branding things as ESG, not having the right kind of discipline and metrics and accounting and auditing functions that Shawn mentioned, very limited regulation, and which led people, kind of the middle people, the asset managers, to potentially brand things as ESG to sell more product to the asset owners, rather compared to what the actual facts were. And it's obviously disappointing that happened, but it doesn't really negate the fundamental issue that, investing in those kind of companies over a period of time would either express your values or are better value over time. And so I think what's this, in a way, you could say that, look, there was a lot of fluff, there was excesses, and that this downturn, if you will, or the ESG backlash, as I mentioned before, is actually helping out clean out some of this stuff. And that the SEC is now stepping in, the regulators are stepping in, there's more awareness on the part of the investors, of the asset owners. So while it is disappointing, it has happened. There clearly were missteps taken, misrepresentations perhaps done. But in the long run, I think, again, in this industry or a style of investing that is early days, these kind of things happen, and in the long run, hopefully this is a good thing because it cleans out the bad stuff. I would also say that in that vein, this course or this webinar has been termed as the future of sustainable investing. Shawn and I talk about the thing that, sustainability will be part of investing. I mean, it's like the future of investing as opposed to the future of sustainable investing. And I think, even in our class, we talk about, well, if you're really successful, there should be no separate course on sustainable investing. It should be part of any investing class. And that's really the hope that we get to. And I think we will get there, where this is not like some separate topic you talk about, but really integrated into the investment process.
Yeah, that makes so much sense. And I think, you had just mentioned a bunch of institutional investors, pension funds, et cetera. There are probably several just retail investors who are joining us today who have a 401k or something like that. Do you think do you have any advice specific to them? Is it just kind of a smaller scale of what you just mentioned for the institutional investors or something different?
Yeah. So I think the difference obviously between institutional investors and retail investors is that, the institutional investors have a whole army of analysts and others to kind of analyze things and make decisions, while a retail investor, you're just doing it through your 401k or some other mechanism. You've got your whole day job, and this is you're investing your savings. And so I think to a large extent, there again, from your perspective, as you think about investing, think about why you're doing it first. The first question is like, why am I doing this? Am I doing this because I believe that this is a good thing to do? Or am I doing this because I think these investments over time, companies that are more ESG oriented, better governance, focus on inequality, focus on climate, will have better value creation and preservation over time. So one is that, as to why are you actually doing it? And it could be a combination of both. And then I think, that's why a lot of our folks taking this course, we found in the last 3 cohorts are intermediaries, wealth planners, financial advisors to retail investors, to not the high net worth family offices, but maybe a level or 2 below that. And there, I think, that's where this last comment that Shawn and I made, where making sure that the investments that you're actually investing in are reflecting what you think you're investing in, as opposed to it being impact washing or greenwashing, is important. And that's where the SEC and regulation is kind of coming in. So I would encourage you to continue to doing it. I think that's where your intermediary and your advisor kind of should be helping you. But I also find that what's happened is that a lot of advisors themselves are not very comfortable on the topic, and therefore we have a course like ours. So anyway, so
I would also say pay attention to fees, right? You might not, you make sure you're not paying a 1.5% management fee for a simple equities fund. But there are, an increasingly diverse range of products being designed for retail investors, which are aiming to match both the value perspective that I want to create value by managing ESG risks, as well as the values perspective. I want the assets that I hold to be consistent with my personal values. So
and there are a lot of ETFs, ETF funds, which are very low fees. And that time, again, some of the discussion on ETF funds as well. How can, Exxon be in a clean, or any oil and gas company be in a clean fund? Well, partly is because we can get into a whole discussion on that ETFs can't completely move away from the index, but they'll be underweight some of the industries, but not completely gone to zero. So you could also have ETFs with basically are zero. So there's a lot of flexibility in creating these products, and ETFs are a pretty transparent way of doing them.
Yeah, it's definitely very exciting to see those opportunities available for someone who, is just doing it on their own. It doesn't have either the resources from an asset perspective or from an advisor perspective that an institutional investor might have. We are kind of approaching time, so I think I'm going to ask just one more question. This whole conversation has been so interesting and so positive, so I'm going to end it on a positive note as well. And I was wondering if each of you could just share, what are you most excited about in the future of the sustainable investing space?
Shawn?
I'm most excited about the potential for impact. These sustainability development, the SDGs are a transformed world of jobs, abundant, high quality jobs for everybody, environment that we can enjoy, our children can enjoy, and our grandchildren can enjoy. And the government and the philanthropy are not enough to get us there. And so we're not going to get there unless we engage the private sector to work towards these goals. And I think a lot of what sustainable and impact investing is saying, let's align the private sector towards these incredibly important goals.
Correct. Yeah, so just to add to that, for just in terms of stats, there's about $7 to $8 trillion needed per year to achieve the UN sustainable goals, to achieve the targets by 2030. And government spending and philanthropy, charity is going to come nowhere close to that. So the real holy grail here is to how do you actually channel private capital, which has fiduciary obligations, which has return requirements, and needs to be doing good to meet the sustainable good goals together. And it's really, really challenging at one time, but seriously rewarding. I also think that just intellectually, as folks who may be interested in this topic, whether you take the course or not, or just read about it or be engaged in it, there's so much change. There's so much uncertainty on this one hand, but I would really emphasize the opportunity here. This is a generational, once in a lifetime opportunity to make a difference in the world, like Shawn was saying, but also generate outsized returns. This is the equivalent of, going from the carriages to the railways and the cars. This is the equivalent of, in 1995, no internet. And if you think about what happened between the late 90s to just in that 5-year time period, all the trillion-dollar companies that we talk about today, except for Apple, were all created in that time period, 20 years ago. And so there is an enormous opportunity here, which makes me really excited about it.
That's great. I certainly am inspired myself, and I've so enjoyed working with both of you on your course. anyone who's joined us today, if you found this conversation interesting, if you'd like to learn more, I'd encourage you to check it out on our website. It's online.hbs.edu, and you can find the Sustainable Investing course there. And I just would like to say thank you to Professors Cole and Gandhi one last time. We so appreciate your wisdom and sharing your time with us today.
Great.
Thank you, everyone, and take care. We'll see you later.
My pleasure.
Thank you.